Welcome back to the Pro Ticker Podcast, everyone. Your Thursday morning edition covering major financial magazine headlines.
Yeah, it's certainly been a wild week in the markets, hasn't it? The Fed's latest move has thrown everyone for a loop.
Yeah, no kidding.
Mhm.
We're going to take a deep dive today into how global markets are reacting to that recent interest rate cut from the Fed, but especially what it signals about what they're thinking for the future. You know what's coming. CNBC, Bloomberg Market Watch, and Reuters. All over this story.
And what I find really interesting is that we're not just seeing the usual, immediate reactions this time.
Yeah.
There's real uncertainty out there about what this means long term. Like, take the Dow Jones, for example. First 10-day losing streak since 1974. That's according to MarketWatch. That's not just a blip. That's people fundamentally reassessing things.
It's wild, right? And then on the complete other side, you've got Bitcoin testing $100,000 again, and Bloomberg is calling it Trump's crypto shadow looming over the market.
Yeah.
So you've got fear and greed all mixed up together. It's a recipe for one heck of a deep dive.
Absolutely. Let's start with what the Fed actually did. CNBC's got the breakdown. They cut rates by 25 basis points, bringing the target range to 4.25% to 4.5%. So, on the surface, that sounds good, right? Stimulus.
Yeah, you'd think so.
But here's the catch. They've also strongly hinted that the pace of these cuts is gonna slow down in 2025. They're only projecting 2 more reductions for the whole year.
And that seems to be what's really freaking the markets out.
Yeah.
It's not so much the cut itself, but what it says about how confident the Fed is about the economy going forward.
Exactly. Remember those 4 rate cuts they were forecasting before? Gone poof. CNBC even quoted Fed Chair Jerome Powell saying, and I quote, "We moved pretty quickly to get to here, and I think going forward, obviously we're moving slower." I mean, that change in language, that's huge.
So what's behind this sudden caution from the Fed? Is it really just about inflation, or is there something more going on?
Well, inflation's definitely the main concern, and rightfully so. It's still way too high, and the Fed's job is to keep prices stable. But if we dig a little deeper, like Bloomberg's analysis did, we start to see some other factors at play. There's a growing concern about a potential global slowdown, especially with New Zealand officially entering a recession. Now, CNBC reported that just this morning.
So the Fed is in a tough spot. They need to keep inflation under control, but they also don't want to accidentally cause a recession by slamming on the brakes too hard.
It's a tightrope walk for sure, and that's creating a ton of uncertainty, and markets hate uncertainty. So we're seeing that play out in these huge swings across different types of assets.
Let's start with U.S. stocks. CNBC's not painting a pretty picture here.
Yeah.
The Dow Jones, as we said on that 10-day losing streak, the S&P 500 down 2.95%, and the NASDAQ Composite losing 3.56%. I mean, those are some serious losses.
And it's not just the U.S., this is global. Asia-Pacific markets also fell hard after the Fed's announcement. According to CNBC, Japan's Nikkei 225 lost 0.69%, South Korea's Kospi dropped 1.95%, and even Australia's S&P SX 200, which is usually pretty resilient, dipped 1.7%. Europe followed with similar drops. It's like a global wave of risk aversion.
So where's all that safe haven money going if stocks are getting hammered?
Well, the dollar's having a moment. As usual, Bloomberg says the dollar index is at a 2-year high, which makes sense. It's seen as a safe haven in times like these. Investors are looking for stability, and the U.S. dollar, despite all its problems, still represents that for a lot of people.
It's funny how even with all the talk of its decline, the dollar still becomes the go-to when things get shaky globally. What about gold, though? Isn't that supposed to be a safe haven, too?
It is. But here's the thing. Bloomberg reported that gold prices actually fell to a 1-month low after the Fed's announcement. And that's because gold doesn't generate any return. So when interest rates go up, it becomes less appealing to hold. Why hold on to something that's not earning you anything when you could put your money into dollar-denominated assets that are suddenly offering a much better return?
So it's a double whammy for gold. Stronger dollar, making it more expensive to buy, and rising interest rates making it less attractive to own. Speaking of assets that don't exactly follow the rules, how's our old friend Bitcoin reacting to all this?
Bitcoin had a little dip below $100,000, but then it bounced back pretty quickly, according to Bloomberg. It's been all over the place lately, mostly driven by speculation about what President-elect Trump is going to do on the crypto front. He's hinted at deregulation, even talked about a national Bitcoin reserve, and that kind of talk can really send the crypto market into a frenzy.
It's amazing how much power his words have.
Yep.
Even before he's officially in office, that's the Trump effect for you.
For sure. Now let's see what the analysts are making of all this. MarketWatch has a good roundup of different opinions, and there's actually a pretty wide range of views.
Hit us with some highlights. Starting with the optimists. What are they saying?
Okay, so the analysts at Wedbush are still bullish on tech stocks. They always are. They see this current sell-off as a buying opportunity. They're predicting continued growth driven by what they call an AI arms race and potential deregulation under Trump. They believe the long-term potential of tech outweighs any short-term jitters.
So they're basically saying, don't panic. This dip is temporary. The tech train is still chugging along.
Exactly. Then we've got Morgan Stanley, who are being a bit more cautious. MarketWatch reports that their economists are only predicting 2 rate cuts in 2025, but they're not ruling out a surprise cut in January. They say potential weather-related impacts on the economy could be a wild card.
Weather-related. Wow. Okay. I guess those economists are really looking at everything.
They have to. And then there's Citigroup. They're taking a more historical approach, according to MarketWatch. They've been analyzing past instances where the Fed paused rate cuts, trying to figure out what those pauses signaled about how the market performed afterwards. Given the current situation, their analysis could be really valuable.
So we've got the bulls, the cautious ones, and the historians, all trying to make sense of this latest move from the Fed.
It's like a financial mystery novel. Everyone's trying to piece together the clues and figure out how it ends.
And to make things even more interesting, we've got some very specific situations and details emerging from around the world that add even more layers to this story.
Let's start with the bad news. As we mentioned earlier, New Zealand's economy is officially in a recession. Now, CNBC confirmed that 2 straight quarters of decline. That's the textbook definition. It's a stark reminder that the global economy is far from being in the clear.
Yeah, that's a bit of a reality check for anyone who thinks the U.S. is immune to these global headwinds.
Yeah, right. But now for some good news, at least for anyone in the U.S. housing market. Matt Ishbia, the CEO of United Wholesale Mortgage, is predicting a rebound in 2025. MarketWatch had this story. He says falling mortgage rates and increased inventory are the key drivers. He's even putting his money where his mouth is. He told MarketWatch that UWM has been hiring like crazy and investing in new technology to prepare for this surge in demand.
That's got to be music to the ears of anyone who's been waiting for a better time to buy a home.
It is. But even with that positive outlook, we have to acknowledge that some sectors are still really struggling, like Micron Technology. They're a leading memory chip maker, and they just missed their revenue forecast. MarketWatch had the details on that. It just goes to show how weak consumer-facing tech markets are right now. Demand for things like PCs and smartphones is definitely softening.
So is this the beginning of the end for the tech boom?
Not necessarily. Micron's CEO, Sanjay Mehrotra, while admitting there are challenges in the short term, is actually betting on AI-driven growth to boost their high-bandwidth memory business, which is crucial for AI applications. So they're shifting their focus from consumer tech to the infrastructure that powers AI, which is a smart move considering how things are going.
It's not a tech apocalypse, but more like a changing of the guard within the sector.
Exactly. And this brings us to another tech player that often gets overlooked but could be a major force in the future, IBM, and their quantum computing ambitions.
Yes, IBM. They've been in the quantum game forever, but they haven't gotten the same hype as some of the newer companies. MarketWatch even pointed out that while companies like Quantum Computing Inc. and IonQ Inc. have seen their stock prices go through the roof, IBM's has stayed pretty flat. But why? They've been at this since the 1980s.
It's a great question. And Ben Reitzes, an analyst at Melius Research who was quoted in that MarketWatch piece, thinks they've been unfairly ignored. He believes IBM has more meat on the bone in quantum computing than anyone, even Google. He predicts quantum could bring IBM billions in revenue and profit by the 2030s.
Billions. That's a bold prediction.
It is. But Reitzes believes IBM is in a unique position to capitalize on this new technology, especially through their hosted services and consulting practices. They're also exploring applications in cybersecurity, even looking at how quantum could be used to protect cryptocurrencies. They're going to share more about their plans at an analyst day in February, so it'll be interesting to see what they have to say.
Wow, it sounds like IBM might be the sleeping giant of quantum computing. They've been quietly building their capabilities for decades, and now they're ready to unleash them on the world. This could be huge.
It could indeed. And it just goes to show that in the world of tech, it's not always about who's the loudest or the flashiest. Sometimes the quiet giants are the ones to watch.
Okay, we need to take a quick break, but when we come back, we'll dive deeper into the potential impact of all this on the housing market and the U.S. economy as a whole. Stay tuned.
Welcome back, everyone. I think it's important to highlight this sense of disconnect we're seeing between all the excitement in the markets and the very real anxieties people are feeling out in the real world.
Oh, absolutely. It's like 2 completely different conversations happening at the same time. You've got tech stocks soaring on dreams of AI, Bitcoin going crazy because of Trump's crypto hints, and then you've got regular folks worried about paying rent, keeping their jobs.
Yeah.
Basic stuff.
Exactly. And that's what makes the Fed's moves so impactful. They're not just setting interest rates, they're trying to manage expectations, trying to project confidence, or at the very least, avoid a full-blown panic.
So when they signal they're going to slow down the rate cuts, like they did this week, it's not just about the numbers, it's about the message they're sending.
Right. And to some, that message is that the Fed's not so sure the economy can handle more stimulus without inflation getting even more out of control.
Right, because let's face it, the I word is still haunting them.
It is, and MarketWatch makes a good point. This current Fed is way more hawkish on inflation than we've seen in decades. They're willing to let the economy take a bit of a hit, even risk a recession to get inflation back down to that 2% target.
And it's interesting, because back in the day, the Fed was often criticized for cutting rates too quickly, for being too concerned with keeping the markets happy. Now it seems like they've swung completely in the other direction.
They have. And I think that's partly due to the unique situation we're in, the lingering effects of the pandemic, the supply chain issues, the war in Europe. This isn't your typical economic cycle, so the old playbook might not work anymore.
They're navigating uncharted territory, and that makes every move they make that much more scrutinized.
And that scrutiny's coming from all angles. You've got the optimists, like those Wedbush analysts we talked about. They think the Fed's being too cautious, that they're going to stifle growth unnecessarily.
And then you've got the pessimists who think the Fed has already waited too long. They say inflation is so baked in now that it'll take a major recession to get it back under control.
Exactly. And then you've got people like the Citigroup analysts digging through historical data, trying to find any insights from past Fed pauses that might shed some light on what's happening now.
So lots of opinions, lots of uncertainty, and that's all reflected in how volatile the markets are being.
Absolutely. Take stocks, for example. We already talked about the Dow's losing streak, but it's important to remember that not all stocks are created equal. Some sectors are more sensitive to changes in interest rates than others.
Like those high-growth tech companies, for example. They rely on cheap money to fuel their expansion.
Exactly. Their valuations are often based on potential future earnings, which get discounted more heavily when interest rates rise. So it's not surprising that we've seen some of those big tech names take a hit this week. Bloomberg's data shows that pretty clearly.
On the other hand, you've got companies with more stable earnings, like in the consumer staples sector. They might not be as affected by interest rate changes.
Right. They provide essential goods and services that people need no matter what's going on with the economy. So their stock prices tend to be more resilient.
So it's not just about whether the market goes up or down. It's about understanding which sectors are likely to do better or worse in different economic environments.
That's a really important point. And it's why diversification is so crucial. You don't want to put all your eggs in one basket, especially when things are this volatile.
Right, spreading your investments across different types of assets so that if one sector takes a hit, the others can help cushion the blow.
Exactly. And it's not just about stocks and bonds. We need to think about other asset classes too. Real estate commodities, even cryptocurrencies.
Speaking of real estate, we mentioned that UWM CEO predicting a rebound in the housing market in 2025. But aren't there some headwinds there too?
There are. MarketWatch pointed out that even though interest rates are rising more slowly than initially expected, they're still going up, which means mortgages are getting more expensive. And affordability is already a huge problem in many parts of the country. So while lower rates and more homes on the market might boost demand, it's not a guaranteed win.
And then you got all this broader economic uncertainty we've been discussing. If we do end up in a recession, that's going to impact the housing market no matter what happens with interest rates.
For sure. People are less likely to buy homes or even refinance their current mortgages if they're worried about their jobs or the economy as a whole.
So it's a bit of a wait-and-see situation for the housing market. A lot depends on what happens with the broader economy in the coming months.
Exactly. Which brings us back to the Fed and their balancing act. They're trying to thread that needle, support growth without letting inflation spiral out of control. And every decision they make has ripple effects throughout the entire financial system.
It's like they're playing a high-stakes game of chess with the global economy as the board.
And every move they make is being watched and analyzed by millions of players around the world. It's fascinating, isn't it?
It really is, and it highlights how interconnected our world is. What happens in one corner of the globe can have a huge impact on markets and economies thousands of miles away.
And that's why staying informed is so important. Understanding the forces at play and making smart decisions about our own finances. We can't control the global economy, but we can control how we react to it.
Well said. Now, before we wrap up this part of our deep dives, I want to shift gears a little and talk about something that's been getting a lot of attention lately, the rise of AI.
Ah, yes, AI. The buzzword du jour, maybe even the buzzword of the decade. It's everywhere. From those Wedbush analysts predicting an AI arms race to Micron banking on AI-driven growth for their memory chips.
It's even found its way into the world of quantum computing with IBM, exploring how quantum can be used to enhance AI capabilities. It feels like AI is infiltrating every aspect of our lives.
It is. And for good reason, AI has the potential to revolutionize everything, from healthcare to transportation to finance.
But it's also raising a lot of questions, right? About job losses, about privacy, about what it even means to be human.
Absolutely. AI is a powerful tool. And like any tool, it can be used for good or for bad. It's up to us as a society to make sure that AI is developed and used responsibly, ethically, and in a way that benefits everyone.
That's a huge responsibility,
Yeah.
and one that we can't take lightly.
No.
We can't just blindly embrace AI without thinking about the potential consequences.
I couldn't agree more. We need to have a thoughtful and nuanced conversation about AI, about its potential benefits and risks, and about how we can shape its development to create a better future for everyone.
Okay, so how do we make sure AI is used for good and not for bad? What steps can we take as a society to mitigate those risks and maximize the benefits?
Well, first and foremost, we need to invest in education and training to help people learn the skills they'll need to thrive in a world powered by AI. We also need to develop clear ethical guidelines for AI development and use to make sure that AI aligns with our values as a society.
Right, we need to make sure AI is used to enhance human abilities, not to replace them or undermine us.
Exactly. And we need to have a open and honest public conversation about AI to make sure everyone's voice is heard and considered as we shape its future.
That's a big ask.
Yeah.
But it's essential if we want to harness the power of AI for the good of all humanity.
I agree. It's a challenge, but it's also an incredible opportunity. AI has the potential to solve some of the world's biggest problems, from climate change to poverty to disease.
So it's not just about making money. It's about making a difference in the world.
Exactly. And that's what makes this such an exciting time to be alive. We're at the beginning of a technological revolution that could completely reshape our world. It's up to us to make sure that revolution leads to a better future for all of us. Welcome back to the show, everyone. So we've talked about the Fed, we've talked about the markets, but let's really dig into this AI thing. It's clearly got everyone's attention.
It does. And for good reason. It feels like AI is everywhere you turn these days. But how does it actually impact the global economy? And what does it mean for investors? That's what I want to unpack.
Right, it's the buzzword of the moment. But it's also stirring up a lot of anxiety. Some see AI as the key to a brighter future. Others are worried about mass unemployment and all sorts of economic chaos.
Yeah, it's definitely a disruptive force, no doubt. But like with any big technological shift, there will be winners and losers.
Yeah.
The key for investors is to figure out which companies and sectors are best positioned to benefit from this whole AI revolution.
Exactly. So where should investors be looking? What are the big trends you're seeing in the AI space?
One thing that jumps out is the rise of these specialized AI chips. MarketWatch had a really interesting article about this. Companies like NVIDIA and AMD are building chips specifically designed for AI workloads. And these chips are getting more powerful and efficient all the time.
So it's not just about software anymore. The hardware is evolving too.
Absolutely. The hardware is essential. Without those specialized chips, AI algorithms would be much slower and less effective. So the companies that are making those chips are probably going to be the big winners in this AI race.
That makes sense. So investors should be looking beyond just the software companies that are developing the AI algorithms. They should be looking at the semiconductor companies too.
Exactly. Another trend to watch is AI's growing role in cloud computing. CNBC highlighted this. Cloud providers like Amazon, Microsoft, Google, they're all integrating AI into their platforms, making it easier and more affordable for businesses to use AI technologies.
So AI is becoming more accessible, more democratic.
Right, and that's a good thing because it means more businesses can benefit from AI. We're already seeing it being used to automate tasks, improve efficiency, make better decisions, and that's happening across a ton of different industries.
That's right. From personalized recommendations when you're shopping online to detecting fraud in the financial system, AI is already making a real difference.
And as AI keeps evolving, we can expect to see even more creative uses for it. Like in healthcare, for example. AI is being used to develop new drugs, diagnose diseases, earlier personalized treatment plans.
It's pretty incredible. So AI is not just about taking away jobs. It's also about creating new ones and improving existing ones.
Exactly. And that's an important point to emphasize. Yes, AI will automate some tasks that humans do now, but it'll also create new opportunities and new jobs that we can't even fathom yet.
Like those AI chip designers we were just talking about.
Exactly. Like any technological revolution, there's going to be an adjustment period. Some workers will need to retrain and learn new skills to stay relevant, But in the long run, I believe AI will lead to a more prosperous and more fulfilling future for all of us.
That's an optimistic view. But not everyone shares that optimism, I'm sure. There's still a lot of concerns about the potential downsides of AI.
Of course. And those concerns are valid. We need to be aware of the risks, Job displacement bias in algorithms, AI being used for harmful purposes. These are all legitimate concerns.
We don't want to end up in some dystopian future where robots are in charge and humans are second-class citizens.
Exactly. That's why it's so important to have open and thoughtful conversations about AI, to make sure it's developed and used responsibly and ethically.
So how do we make sure AI is a force for good in the world? What steps can we take as a society to manage the risks and maximize the benefits?
Well, I think education and training are key. We need to make sure people have the skills they need to thrive in an economy powered by AI. And we need to develop clear ethical guidelines for how AI is developed and used to make sure it reflects our values as a society.
Right. We need to make sure AI is used to help humans, not to replace or control them.
Exactly. And we need to have a real public debate about the implications of AI to make sure everyone has a say in shaping its future.
That's a tall order, but it's a crucial one if we want to harness the power of AI for the benefit of all humankind.
It is. But it's also an incredible opportunity. AI has the potential to help us solve some of the world's toughest challenges. Climate change, poverty, disease. These are issues that AI could help us tackle.
So it's not just about making money, it's about making a difference in the world.
Exactly.
Yeah.
And that's what makes this such an exciting time. We're at the very beginning of a technological revolution that could reshape our world in profound ways. It's up to us to guide that revolution and make sure it leads to a better future for everyone.
Couldn't have said it better myself. Well, folks, it looks like we've come to the end of another deep dive. We've covered a lot of ground today, from the Fed's latest move to the rise of AI and what it all means for the global economy.
It's been quite a journey.
It has, and I hope our listeners have found it informative and engaging. We tackled some complex topics today, but I think we also came away with some reasons to be optimistic about the future.
I think so, too. The world's changing fast, but we humans are pretty good at adapting. And I believe we can navigate these changes and create a future that's better for everyone.
Well said. That's all the time we have for today, but be sure to join us again tomorrow morning for another deep dive into the latest financial news.
That's right. We'll be back with fresh headlines from the major financial magazines. Until then, happy investing, everyone.